Hi, and welcome to this week's look at the major stories that have impacted the market so far, and possibly what we're going to see over the coming days. Now, we're going to start with the yield curve and the stock market downside risk that this is potentially indicating at the moment. Now, the yield curve compares the 3-month, 2-year, 5-year, 10-year and 30-year US Treasury bond yields. Now, under a normal curve, the longer the maturity, the higher the yield. That makes sense. The longer you give them the money for, the more they pay you. However, analysts at Crescat Capital are actually pointing to an inversion in the current bond market. Yields on the short-term bonds are clearly higher than those longer-term bonds. But what does it mean? Well, it can be seen as a harbinger of a sharp decline in stock market prices. In fact, we've seen this before historically. Now, the inversion was observed before the banking crisis back in 2008, the dot-com bubble back in 2000, and we saw it just before a sharp decline in the price of the S&P 500 during the pandemic in 2020. Now, this time the danger may lie primarily for the tech stocks in the Nasdaq 100, because we're seeing a lot of AI hype, as we've spoken about before, and the futures for the E-mini Nasdaq have fallen much quicker than those of the E-mini S&P this week. And the Nasdaq 100 chart is also showing some alarming signs. The price broke down the channel shown in blue of the uptrend, which has been operating on the market since early May this year. The bulls have been feeling support from around the 14,700 level, which served as resistance early this month, but could that change? But support could also be short-lived, and the market could turn according to the urgency of the yield curve warning. So what we're basically saying is there are indicators there that things could get worse, but nobody's quite sure. A lot of AI hype. Is that enough to prop the market up? Volatility is certainly out there. Quick look now at one of the major currency pairs, at sterling against the euro. And in fact, GBP has made a sudden dip against the euro. Now, despite the coronavirus pandemic, Brexit, etc., cost of living crisis, a much hyped, particularly by the press, recession has never materialised, or at least up until this point. Now, that recession talk is back in the press again, and has been quite strong in the last few days in the UK. In fact, Tuesday, the pound reacted, falling from around the 117 mark at the open to the low 1.16 by lunchtime on Tuesday. And it's currently around the 115.75 to 115.80 mark now. However, it's worth noting that whilst this represented a 5-day low, it had soared the day prior and basically suddenly gave those gains up to go back to last week's level. We've already mentioned today and previous videos the emergence of volatility in certain markets, and the major currencies aren't escaping that. In fact, this volatility, the likes of we haven't seen for a very, very long time. An increase by 1.5 cents followed by a decrease of 1.5 cents is pretty chunky for the FX market in such an established major. We saw the pound was in steady decline in 2022. That suddenly ceased at the start of this year, and in fact a resurgence has taken place despite still what is a pretty gloomy outlook. So why the sudden volatility? Is it the negative headlines that we've been seeing, just adding a little bit of spice to market? Is a recession actually on the cards? There is talk about it globally again at the moment. Or are the public pretty much bored of this sort of talk? It's difficult to tell. It's obviously very difficult to tell what's going to happen in the coming days and weeks. But uncertainty drives volatility. Therefore, GBP versus any of the majors are certainly markets to watch. But obviously with volatility comes risks. So don't forget your risk management techniques. So we're seeing some interesting moves and talk coming out about indices and FX. But what about some of the other asset classes? And a quick look at commodity now and gold. And in fact, gold has dropped to a 3-month low. Yesterday, there was a forum of the heads of central banks, which was held and organised by the ECB. We had speeches given by Lagarde, Powell, Ueda and Bailey. Now, these bankers suggest, with the exception of Japan, it's worth pointing out, not a surprise though, that they intend to maintain a tight monetary policy moving forwards. They're not excluding new interest rate increases, and the plan is that inflation will continue to fall. Now, the UK obviously having a little bit of trouble getting inflation down, and we saw that 0.5% increase in the interest rate just last week. But the other economies certainly seem to be getting a better grip of inflation. Now, off the back of that, the price of gold fell. Now, one of the reasons could well be because forecasts for lower inflation reduce the value of gold as a rescue asset, a safe haven. If we take a quick look at the chart shows that it made a bearish breakout of the ascending channel that's been in place for some time and is in fact approaching the psychological level of $1,900 an ounce, currently around the 1910 mark. Now, we would normally expect a rebound to a resistance level of sort of 1935, that's $1,935 an ounce, which was pronounced support in early May. But with all this talk of lower inflation and higher interest rates, of recessions, will that happen? It's going to be an interesting time for gold, as we say, rescue asset or a safe haven asset. How are people going to view it in the coming months? Okay, we're going to finish up this week and we're going to have a look at an individual equity, as we like to give a wide range of asset classes when we do this. And this week's in Apple. Share price hit an all-time high. It topped $189 per share yesterday, which obviously getting pretty close to that psychological $190 per share level. Since the start of this year, Apple share price has gone up 50%. Well, that's pretty impressive going. But why? Well, most analysts are talking, obviously, and we've already mentioned it today, the AI hype. There's no real getting away from this. Seems to be driving a lot of tech stocks at the moment, but also with Apple product improvement and new products, which has always been a driver for their share price. They're talking about the Watch Ultra and the iPhone 15 due out later this year. CNBC has stated recently that Apple is working on Vision Pro's second generation. That's their VR helmet, for want of a better word, they launched earlier this year, and they're also working on a cheaper version. We've seen that with Apple recent years. They've got the higher end products, but they're also bringing out, cheaper versions to appeal to a wider market. Also talking about a new line of laptops, new chip, etc. So this has historically has always helped push Apple's share price up a little bit. Take a look at the chart. Well, that shows that the price said goodbye to that down channel, which you can see in red quite vehemently recently. And there's in fact a strong pattern emerged near the $175 level. At first it was resistance and has since become support. And you can see that if you look at the arrows on the chart. Now, if this increase in share price continues, market capitalization of Apple could reach $3 trillion. I think it's fair to say that's pretty chunky. Out of 42 analysts that were surveyed by MarketWatch, there was only one sell rating. Again, gives you an indication of what the main analysts think about this particular stock. Now, we may well see in the coming days news about increased target values, as the current average from analysts would be about the 187.19 mark. That's $187.19 per share, which obviously, based on the current price, is below current value. So it might be worth keeping your eye open on what these analysts think is going to be the longer term price target. Now, certainly one of the biggest, most recognised stocks in the world, enjoying a pretty good phase at the moment. But when we throw in the yield curves we spoke about earlier, tech stocks could be at risk. So as ever, risk management techniques are needed. We wish you luck with your trading for the week ahead. Goodbye for now.